Las Vegas Sands reported earnings for the first quarter of 2024 after the market closed on Wednesday, and the market's reaction isn't very positive at all. As I'm recording on Thursday, shares are down 9%, despite the fact that I don't think results were actually all that bad. But as always in the casino industry, there's a lot of context that's needed. So that's what I want to dig through today is the results and then how to interpret this compared to how the industry is doing overall in Singapore and in Macau, because remember, Las Vegas Sands is actually an Asian casino company now. It sold all of its US properties. So I'm going to dig through the results and hopefully help understand how Las Vegas Sands is doing and then what to expect from some of the competitors that are going to be reporting later this month. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get right to the results. This is a look at the press release from Las Vegas Sands. And as always with these results, I'm going to analyze them on their own. I'm not really worried about analyst expectations and what their guess was for what the quarter was going to look like, because we want to look at this with fresh eyes and look at how are they doing versus the trends that you would expect in their given market. So that's a little bit of the backdrop. Net revenue for the company, $2.96 billion, and a net income of $583 million. This is coming off of the pandemic. So this is a company in an industry that has gone from just a terrible time in 2020 and 2021, and really in Macau, even a year ago was pretty bad, to now being very, very profitable, run rate of over $2 billion in net income. So just a huge turnaround for the industry. Consolidated adjusted EBITDA was $1.21 billion for the quarter. These are results are broken into two segments. Primarily, Macau had adjusted EBITDA of $610 million on a hold. They did have a negative impact of $31 million in the quarter from worse hold than you would expect, or basically gamblers being a little bit luckier than you would expect normally. But Marina Bay Sands more than made up for that. They had $595 million in adjusted EBITDA, so a run rate of over $2 billion on an annual basis of adjusted property EBITDA, or a proxy for cash flow from coming from just that one casino. But they were helped by hold to the tune of about $77 million. So usually these things balance out over time. I like to just look at the numbers that we have, not the hold adjusted numbers, because eventually hold will work itself out. Las Vegas Sands did also repurchase $450 million worth of stock in the quarter. Did that at a much higher price point than we have today. I believe it was $52 per share is where they were purchasing. So after the day that we've had today, looks like those share repurchases maybe could have been put off a little bit. I do want to look at these balance sheet items because this will help a little bit with the analysis of is the valuation reasonable right now. Unrestricted cash was about $5 billion for the company overall, and there was debt of nearly $14 billion on the balance sheet. So in total, Las Vegas Sands has about $9 billion worth of net debt. Now, this is a little bit confusing because Las Vegas Sands doesn't own 100% of its Macau properties, but what they're reporting is the consolidated numbers or the full numbers for the year. Here's the breakdown on a per casino basis, and then the bigger thing to look at is Macau operations versus Marina Bay Sands operations. So Macau had a 42% increase in revenue to $1.8 billion in the quarter. I'm going to put this into context in just a second when we look at Macau overall. But Marina Bay Sands was up to $1.16 billion in revenue in total. That's how you get to the $2.96 billion in revenue. Adjusted EBITDA, $610 million in Macau and nearly $600 million at Marina Bay Sands. These adjusted property EBITDA margins are historically something that just blows me away, because it used to be that a 30% margin was just phenomenal in the gaming industry. You were hoping for 25% or so, but right now we're seeing Marina Bay Sands, look at this, 52% EBITDA margin. That is just phenomenal operating leverage in the business, and a lot of the casinos in Macau are doing in excess of 30%. In total, we have a margin of 33.7%. So this is something we've seen across the industry, is a lot of these casinos are getting more profitable because they're now more efficient. So they've taken some of the costs out during the pandemic and then didn't add all that cost back. At the same time, we have seen gaming rebound in basically every single market to a level that is higher than it was before the pandemic. Las Vegas and Singapore in particular, Macau isn't quite there, but it will likely overshoot the pre-pandemic numbers probably this year or next year. So that's one of the reasons that we're having much better margins than we were previously. So on that trend, everything is going well. But I do want to compare these numbers to the growth numbers in Macau overall. And this is the direct numbers from the Gaming and Inspection Coordination Bureau in Macau. These numbers are in patacas, macanese patacas. So this is the direct number, not converted into US dollars. But you can see that for the first quarter, in the first 3 months of the year, the entire region grew 65.5%. So that's really the bar that you're measuring Las Vegas Sands against. And on that metric, we're seeing that Las Vegas Sands is losing market share. It's not growing as quickly as the market overall. So that's maybe what investors are a little bit disappointed in. And when you look at some of these operating metrics, and they do some nice charts here on the right, you can see that growth has kind of stalled out over the last few quarters for Las Vegas Sands, or Sands China, which is actually their Macau subsidiary. And that's in large part because this is really a mass market business. The mass market is more traditionally what we would see here in the US. It's not rolling volume where they're actually borrowing money to gamblers. This is kind of like the high-end measure in Macau is rolling volume. And what you're going to see at a company like Wynn Resorts, for example, is a much higher rolling volume number because they cater more to those high-end gamblers. So the mass market is going to go to Las Vegas Sands when people are traveling a lot to Macau, doing those day trips, losing maybe a couple $1,000s, maybe a little bit more than that. That's really where Las Vegas Sands makes its money. Very high margin, but it requires a lot of visitors. So the other casino companies, in particular Wynn Resorts, but I think MGM Resorts is playing into this as well, does much better on the higher end of the market. And so they don't necessarily need quite as many gamblers because those gamblers are losing millions of dollars at a time. So this is one of the reasons that the numbers don't necessarily look as good as they might for some of the other casino operators who probably will grow in excess of that 65% number for the market overall. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So what we're seeing right now, I think, is that Las Vegas Sands is very profitable, generating a ton of cash flow, now buying back stock, even paying a nice dividend. But what's important in the casino industry is valuation. And right now, the company's market cap is $34 billion. And like I said, they do have net debt of $9 billion. Now, without considering the majority stake in Sands China, that means that the enterprise value, or the market cap plus the net debt, divided by adjusted EBITDA run rate is about 9 times right now. Now that's a reasonable valuation, but it's not a cheap valuation, especially when a company like Las Vegas Sands is losing market share. So what investors are really looking at today is, what's the trajectory of the business? Is it moving in the right direction? And are shares overvalued or not based on that trajectory? And what I think the response today is that we are seeing Las Vegas Sands lose market share. And if that continues, shares could continue to be under pressure because at the end of the day, buying back $400 or $500 million worth of stock isn't that big a deal when you have a market cap in excess of $30 billion. But what I do take from this is that Macau is doing reasonably well, and probably some of the other players that we're going to see report in the next few weeks, like MGM, like Wynn Resorts, are probably going to have results that exceed what we saw from Sands China. So that's what I'm going to be keeping an eye on. I don't own shares of Las Vegas Sands at this point, but I do own shares of MGM Resorts. They're a company that has also been buying back stock at a really rapid rate, but I think their multiple is much, much lower when you look at their stakes, not only in China, but also with the online gambling business. The casino industry is always about valuation and the direction and cash flow that you're generating from the business. That's what I'm seeing is a little disappointment with Las Vegas Sands in the first quarter, but we will see if that continues with some of their competitors or whether they outperformed a bit in the first quarter. Stay tuned for more on those and subscribe to Asymmetric Investing if you want to know more about this industry. Thanks for watching, everybody. See you here next time.